In doing my research for this week's video, the one thing I soon learned is, man, there's a lot of different opinions out there with regards to the impact this pandemic is going to have on the real estate market. Everything from the doomsday scenario to things are going to bounce back really, really quickly. Hi, this is Andrew with the Andrew Smith team at eXp Realty. And I guess the one good thing about living in the age of having access to as much information as we do is that there's a lot of information out there. The downside to that is there's a lot of information out there. And what is surprising to me as I went through the articles and the videos that I watched is the lack of much of the opinions based on any sort of economic principles. And I am certainly not an economist. I did my economics classes, but I do fundamentally know that supply and demand has a huge impact on the price of any good service commodity. We saw that in the last month with oil. Look at what happened. Demand dropped as everyone was home. No one's traveling, no one's going out. So as demand fell through the floor, what happened to oil prices? They plummeted. They dropped substantially. They're now starting to come back, but they dropped substantially. And the reason I bring that up is that supply and demand aspect of homes is going to impact what happens to pricing going forward. Is it the only thing that's going to impact pricing? No. We've got unemployment to talk about, and we've also got the recession and the stimulus and what's going on there with companies, the economy as a whole. But supply and demand is definitely going to play into that. And, I can say that bad news sells. There's a lot of negative headlines. There's a lot of doomsday predictions that I personally don't know what they're based on, except a dramatic headline. There's also some overly optimistic projections. It's almost as though burying your head in the sand as though there isn't a problem. There is. We definitely have challenges ahead. So what I thought I'd do today is just kind of break some of this out, provide some actual facts and information that you have it so you can make the best decision for you and your own family situation. So first off, let's talk about supply and demand for just a second. Unlike 2008, there was a low shortage short supply in the real estate market. That was causing home prices to continue to go up. High demand, and there has been high demand, coupled with short supply. In 2008, we had a bubble that was artificial demand created by a frenzy. Anybody could get a loan, and an oversupply, which is not the case that we have today, first. So you have that aspect of it. So going forward, we are still seeing, in the midst of this, home prices still appreciating. In the two markets I work most, myself, my team, Frisco, Texas in North Texas, and Temecula, California in Southern California. Frisco, Texas, as of the end of April, the median sales price was still up 1.1% year over year. In Temecula, the median sales price was up 7.9% year over year. Agents I'm talking to, colleagues in both markets, are still saying that demand's strong. Homes are still selling in the midst of this. And while yes, there was a dramatic drop-off in activity, that has started to return. And it is being shown, even a new report this past week by Zillow. They are saying that online search activity and requests for information on properties has gone up. ShowingTime, a showing booking service, has noted that requests for showings, whether in person in areas where you could or virtual showings, has also gone up. So there is still demand in the marketplace. But what about unemployment? where does unemployment fall out? And you've got mortgage forbearances, and that there's going to be this tsunami of foreclosures. So let's break that down and let's look at that just for a second. Unemployment is obviously at levels that are unprecedented. They've never spiked this high in any other event that we've had, going back to the Great Depression. The interesting thing is, when you look at information that was provided by First American, they actually started breaking it down in different metro areas. Rather than looking at the overall national unemployment, they looked at state unemployment to see what was actually going on at a state level. And what they found, even though it may not be the best indicator, but what they did find is that the unemployment filing trends were actually mirroring what happens after a natural disaster. And here's what I mean. When you look at the Great Recession, let's go back to 2008 for a minute. From the time the markets, all of the markets, the recession started, it took 2 years in order for total unemployment to bottom out. The job losses took 2 years to bottom out. It wound its way down before starting back up. And when you have a natural disaster, you usually see a spike during the time of the disaster, and within a few months after that they've gotten over the initial hurdle of that, you start to see many of those jobs come back. If we look at what's going on today, the number of unemployment filings, although absolutely astronomically high, has been declining every single week since the end of March. The end of March, we had 6.6 million claims in 1 week. As of the week ending May 2nd, it was down to 2.5 million claims. So still a lot, still absolutely huge numbers, but they are trending down, causing many to predict that the bottom is already in sight. It's going to be a very sharp drop, which we've seen, going then a turnaround, and we'll start to see a return. How long will it take? Consensus right now seems to be about 2 years. It's going to take at least 2 years for all of the jobs to come back. Most don't see it taking more than 3. 2 seems to be the consensus that we have. But as a result of that, if there's that much unemployment, if all of these foreclosures come to the market, isn't that going to cause an increase in supply, which is going to put negative pressure on home prices? Not necessarily in that regard. And here's why. The big difference between 2008 and now is in 2008, the majority of homeowners were over leveraged. There wasn't a whole lot of equity in homes. In the market today, 58.7% of all households have at least 60% equity. 42.1% of homes are owned free and clear. When you look at all of it, you have 86% of all homes in the country have at least 20% equity in them currently. That didn't happen back in 2008. Hence the wave of short sales. After the initial run of foreclosures, there was all of these short sales. So those short sales themselves were people that trying to get out, didn't have enough proceeds from the sale of the home to pay off the loan. Hence they were short. Right now, that's not the case. So how does that tie into mortgage forbearance? What's going to happen there? All of the rules for mortgage forbearance are still going to play out. The banks, the federal government are trying to get ahead of it rather than being behind it like they were in 2008. And the common thought is that, well, people go into mortgage forbearance, they don't have to make payments for 3 to 6 months, then there's one lump sum payment to be made. That's going to force people into foreclosure. Maybe, maybe not. That's something that hasn't been determined yet. If you've probably noticed, the stimulus that is coming out from the government is coming out in waves. So the first round of stimulus came out, which allowed for mortgage forbearance. The second round that they started to clarified many of those rules, but they said, no, We don't intend for those lump sum payments to be due. We actually intend for that to be spread out. We intend for there to be options available for people. Not if someone hasn't been making money for 4 or 5 months, how are they going to make a lump sum payment? I still think you're going to see additional rule changes there. And Fannie Mae and Freddie Mac, the government entities, are already saying a lump sum payment is never part of the plan. We're going to be working with those borrowers to either add that to the end of their loan or come up with a repayment schedule that works for them. So I think the writing's still on the wall. With regards to that, the ink isn't dry. In other words, it's not going to be a wave of foreclosures based on the information I am seeing today. So let's assume a worst case scenario. Let's say someone was in mortgage forbearance and then their bank isn't participating, or there is a lump sum. Well, based on the equity numbers I gave you just a couple of minutes ago, someone could put their home up for sale, pay the loan off, including the forbearance amount, put money in their pocket and move. Not everybody, but the vast majority, based upon the equity available in most homes today. So it's a very different situation. Now, a caveat to all of this with regards to prices is the jumbo market. It's financing. So, there's two sides of the equation, supply and demand. I just talked on supply. Well, what about demand? Demand right now, as I mentioned, is still strong. It hasn't gone anywhere. Could that change? Yes. But right now, the imbalance between demand and supply is enough that we can absorb a drop in demand and still not have great downward pressure on prices in the vast majority of the country. That's not everywhere though, and it's not all markets. So the jumbo market, anyone looking to buy a home using jumbo financing, that's not as available right now. There's a lot of banks that aren't making jumbo loans. Chase isn't even going to look at jumbo loans until the end of the year. They're not the only ones. Some credit standards have tightened. So that could push some buyers out of the market and have an impact, especially in those jumbo loans. You've also got pockets. The vast majority of the initial unemployment filings are all service-related industries. Some of those that they believe to be temporary, unfortunately, are going to end up permanent. Not all businesses are going to survive that. It will spill over into other industries. Areas like Las Vegas, they've been hammered. They've been hit really hard. You could end up seeing some flattening or decline in prices in that market. Parts of Michigan could also see it. There's pockets in Florida, but they're isolated. I mean, it's very, very local. You can't just say this is going to happen everywhere because it's not. North Texas, for instance, where I am, don't really see a big drop in pricing coming on. The economy is still strong. And it's not all service-based. There's other industries at play. So it really does depend on where it is that you are. A report that just came out yesterday from Moody's indicated that in the areas where there is a price decline, they don't expect that to exceed 5%. That's nothing like the 30 to 40% we saw during the 2008 crash. And most of the major banks and economists out there right now are predicting that home prices will actually be fairly flat or continue to appreciate in many markets, but just at a slower pace than what was previously predicted. So hopefully that helps cut through some of the clutter. At least, again, I'm certainly not claiming to be an expert on all of this, but I do know some of those fundamental principles need to be taken into account in order to determine exactly which way all of this is going to go, because nobody knows for sure. I mean, we haven't seen anything exactly like this before, and time will tell. As different states start to reopen, we are seeing a bounce in some areas, and we are seeing some things start to return to normal. Carlos Rodriguez, the CEO of ADP, has indicated they've already started to see a normalization with some companies and an increase in the number of job postings. So that's kind of another leading indicator that things may start to return back to normal. We're definitely not just going to flip on a light switch. It's going to take a little time, but all things being considered, all we can do is hope that it's not as catastrophic as some of those reports out there seem to indicate that it might. Now, over the past couple of months, I've put out some other information on mortgage forbearances, gone into greater detail on the differences between now and 2008, and I'm going to include a link to those videos in the description below this one.